And we have some very, very interesting things to discuss over the next 45 minutes, I think, with the ECB rate decision yesterday, delivering exactly what we expected, to be honest, a very, very dovish statement. On the other hand, there was at least a short-term push on the upside, a very aggressive push higher in the EURUSD, which nevertheless didn't bring us back of 112, and now we are going down towards 111 again. I think the overall outlook is very, very skeptical or bearish for the euro in general, especially if today's GDP data from the US convince, respectively, next week the Fed delivers as expected, and then much of the rate cut there is already priced in. And I don't really see that there will be plenty of other choices than to deliver as expected and probably trigger some US dollar bullishness. Before we start, nevertheless, as usual, we have to have a look here at the risk disclaimer. So trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and the conditions of the service from Admiral Markets. These were the two first sentences. For any further any further sentences here, respectively, the whole risk disclaimer, please feel free to have a look at the website from Admiral Markets. As usual, nevertheless, we want to have a look here at the so-called ESMA decision. It has now its first birthday, let's say. There's a differentiation between retail clients and professional clients. And what this means for your trading is especially important from a leverage perspective. So leverage restriction now for retail clients with a max of 1 to 30 for Forex majors and 1 to 20 for other currency pairs. Forex majors like EURUSD, Forex minors like Euro Australian dollar, for example, with a max leverage then of 1 to 20. And also this leverage cap is in place for CFDs on indices. We will have a look here at the DAX 30 CFD, but also, for example, gold. And on top of that, there's also something very important to note here. It's not only this leverage restriction, which is in play for retail clients and is not effective for so-called professional clients. To be reclassified as a professional client, please feel free to reach out to the website from Admiral Markets and find out further details on that. For example, it is that you have to have 1 year of experience in working experience, professional experience in the, for example, CFD business or in the financial industry in general. So as a bank employee, for example, but also you have to bring minimum 10 trades per quarter in regards to transactions. Or you have to have minimum 500,000 in liquid assets available. So in this case, or in my case, in this case, euro, for example, but also US dollar or an equivalent. Yeah, if you want to be reclassified as a professional client, feel free to reach out to Admiral Markets to get further information on that. Respectively, find them on the website, described on the website. Sorry. But on top of that, there's also a very interesting point in regards to the negative balance protection. So as a retail client, you have such a leverage restriction, but in addition to that, you're protected to an unlimited amount here when it comes to negative balances. While as a professional client, this is not necessarily the case. But if you trade as a professional client with Admiral Markets, then you're safe up to 50,000 pounds sterling, according to the policy from Admiral Markets here in regards to negative balances. Also here, please feel free to reach out to Admiral directly. So I'm not really sure whether you can see my face right now. So the webcam, it should be switched on. But if you can't see it, well, then this is the face of the voice you're currently listening to. And I'll get into further details in a few seconds. Probably you will get an idea on my person a little better thanks to an interview which I had the pleasure to have with Admiral here several days ago, and it was published yesterday. And I will show you here where to find it on the website. I'm located in Germany, and now we come to the question, why Admiral Markets? So in Germany, we usually refer to Admiral as the so-called DAX expert. So, which means that with a typical spread of 0.8 here points in regards to the spread during the main trading hours, Admiral has a very, very competitive offering when it comes to DAX trading. In addition to that, there's also the so-called Admiral Prime solution. There you have a 0.2 point spread. And on top of that, a commission, which is very interesting, for example, for scalpers or very short-term traders, let's say. In addition to that, there's also a very, very competitive offering when it comes to FX trading. So I highly recommend I'm having a deeper look here at the offering from Admiral. And okay. Yeah, so I'm located in Berlin, as I already said, in Germany, Berlin, Germany. But Admiral has offices around the globe. One in Berlin, Germany, yes, but also, for example, in London, but also one in Cyprus, one in Chile, one in Australia, for example. There's also here, when it comes to the Admiral Markets Pty Limited in Australia, the fact that there's a license being held from Admiral, Australian Financial Service license here. So Admiral is a broker which has a global presence, and that said is probably of interest for many, many traders around the globe. And yeah, one of the reasons also here the webinars are held in English, and hopefully we'll reach out to also people which are probably, let's say, somewhere in Australia or something. It's definitely nice to know that we stream worldwide. There are the contact details. Please feel free to reach out to Admiral directly. And now we come to the weekly market outlook. After this introduction, we want to have a look here at the following questions, or deliver the answers, some answers, hopefully some good answers to the following questions. So what are the key economic events in the coming week of trading? I already mentioned it will be the Fed next Wednesday. We also have some other economic indicators like the ISM manufacturing. We have the non-farm payrolls next week on Friday. So it's a really packed agenda. And I have to say that after yesterday, I have a clear opinion of where, for example, EURUSD is potentially headed, especially if numbers come out better than expected and the Fed delivers as expected. But we'll dig a little deeper into that in a few seconds then. Then also the question, what's the current bias in FX equity and commodity markets, mainly driven when looking at the DAX, for example, to or from the ECB yesterday. The price action was very, very interesting, even though I have to say it's probably only a short-term reaction. It's been a short-term reaction, and then we shouldn't really think that now bears are in full control. Let's see once this would be given. This would be a given fact that bears have the advantage on their side. But still, right now, I'm not really sure if bears are in charge, or probably we should expect some choppy price action, at least for the upcoming days, and then a drift higher. And then, sure, we want to answer the question, which trading opportunities may arise. And then we exit this screen here. By the way, today I don't have two screens. That's why I have to click a little here. But I hope that screen sharing was interrupted. So can you still see me? Let me just open here the F&A section. I just hope that you can still see my screen. I'm a little irritated, so I get. Yes. Okay. Perfect. Thanks a lot. Thanks a lot for the info. So everyone can see my screen then. So I get an info here which says that I'm not sharing my screen anymore for whatever reason. Let me just see again here. Yes, it's okay. Perfect. Okay. So then, yeah, let's start here with EURUSD. And have a look at what happened yesterday. You can already see it here. It's a 4-hour chart. Still, there have been two quite huge candles compared to the very low volatility of the last last weeks here. In fact, so there has been some pressure on the downside when we topped out around 112.80, 113. That has been on the. Oh, okay. So let me just see then. Can I? So you can see my screen. I just found out that you can see my screen, but Beautiful. So 1 second, let me just see. Huh. So what about this? So now you can see my MetaTrader, right? EURUSD 4-hour. Everything should be fine now. Our agenda. Okay, now good. Okay, now it's perfect. Awesome. Okay, so you have seen yesterday here some sharp swings with a push, and in fact, we slightly spiked to new yearly lows here, even though then there was a sharp reversal. So what happened there, respectively, what happened already the days before when we topped out? That was last week on Thursday, I'm sorry. That was on Thursday. We didn't make it above 113, and then we drifted lower. In fact, the picture didn't really change when looking at the daily chart. And then from there, we took on bearish momentum. By the way, I already have a look here at the DAX, so to give you an idea of here, that we've seen also some bullish price action over the last days. This is the daily chart, as you can see here. So there has been a drift higher towards the highs, even though we didn't make it to new yearly highs. And so what happened there was, in fact, this is my interpretation, I have to say, but still, I think it's a valid interpretation. So we have seen an anticipation of a very, very dovish ECB yesterday, and the ECB delivered as expected. What does dovishness mean? Well, there have been rumors, in fact, from some sides that there's also some potential of a rate cut into negative territory yesterday already from the ECB. I wasn't really convinced that it would happen, and in fact it didn't, but still there was a very dovish rhetoric, and there's more and more signs pointing towards a rate cut then happening in September into negative territory. Plus, on top of that, there is some also now speculation arising that there will be some further monetary stimulus in regards to the QE program. There's also speculation around tiered rates. What does tiered rates mean? It means nothing more than and therefore, probably we look at an example. Look at Deutsche Bank and the trouble Deutsche faces right now. It's not only Deutsche. In case of Deutsche, still it's a big issue, a big issue, due to their very low capital reserves they have and market cap they have now. So they dropped below 20 billion already several months ago, nearly a year ago. And on the other hand, have a very high derivatives exposure, respectively, a very, very packed derivatives book. And we know this has been the case also when we faced the very bad situation around Lehman Brothers around a decade ago, around the financial crisis. And so the overall business model from Deutsche is in danger due to the yield policy from the ECB and margins being lowered more and more by the ECB holding rates very low for an extended period of time. And tiered rates means nothing more than say, okay, you are facing, what's the word for? I'm currently missing the word. You don't have to pay, let's put it that way. You don't have to pay a certain amount here to us under certain circumstances. And if you do meet them, well, you don't have to pay, let's say, 1 million, but only 500,000, to just give you a number, or put a percentage sign in front of that. Instead of 0.5, you only have to pay 0.25, for example, just half of it. Then this is what's meant by saying tiered interest rates. So all these measures, and especially tiered rates, they point to a certain monetary policy in the past and what to expect from the ECB. If the ECB is going the way, for example, through tiered rates, it means nothing more than they will hold yields very low for an extended period of time. So that means a very, very expensive monetary policy approach then in this regards. All this was delivered yesterday, and there was already speculations of a rate cut yesterday, even though it wasn't delivered. And the push lower then here resulted out of the fact that market participants started really to see, okay, there's lots of dovishness in the statement from the ECB. I've already prepared something here to just give you an idea. So the ECB orders review of options, including tiered system for rates. ECB will examine options for potential new asset buying. So that was what I already said. They kept interest rates at the same level as before, at 0. Still, chances are high that they will cut rates. And this is something which can be seen or read between the lines when listening to the words from Mario Draghi yesterday at the press conference, when he referred to the situation getting worse and worse in regards to European economy. This is especially true when looking at the Germany, for example, and the worsening outlook for the overall German economy. But in addition to that, there's also signs pointing to a rate cut then in September, when looking at the wording which was used in regards to the inflation outlook, for example. So there have been plenty of reasons, even though now the thing is, okay, that's probably then driving EURUSD lower, okay? Fair enough. Since this is euro bearish, since yields shouldn't be expected to rise in the mid to long term, especially. But then look at this. Why is this happening? Why did we get to see such a sharp push higher towards 111, 112 within, in fact, seconds? And in addition to that, by the way, it wasn't only the euro which shot higher, but we've also seen a dramatic push lower here in the DAX. So initially, the DAX saw a test of the region around 12,600 points, was a short spike towards it, but still after that, it dropped aggressively lower, and there was a huge selling pressure happening. And this had nothing to do with weakness from U.S. equity markets or something, but it happened already before U.S. markets opened. So in fact, the stabilization in U.S. equities was the reason why the DAX didn't continue to drop sharply lower. And plus, in addition to that, there's also something which is probably playing a role for the overall outlook. Therefore, we have to scroll a little higher, but you will see it here. Where do you have it? One second. So there's the wording here. Outlook is getting worse and worse, getting worse in manufacturing especially. But 1 second. Where do we have it? Where do we have? There we have it. This is the main driver for the bearish reaction in the DAX, respectively, in the bullish reaction in the euro, at least the short-term bullishness. No absolute exclusion of any instrument, but, and this is the thing, no discussion of a rate cut today. So market participants are expecting a rate cut, yes, and when looking at money at the short-term money markets, let's say, you can see that there's a high expectation in regards to a rate cut of the Fed then, at the September meeting. And by the way, yesterday the expectation was at around 30%, if I'm not mistaken. But here he clearly mentions that there was no such discussion happening at the meeting yesterday, respectively on Wednesday starting already. And this was something what delivered for market participants a potential trigger that they said, oh, this is not what we expected. We expected them to discuss it today. Okay, no implementation, yes, but still at least a discussion so that they prepare for such a step then in September. And when it was seen that this didn't happen, and Draghi clearly said no discussion of a rate cut today, the reaction was, as we have already seen it, Euro pushed higher while the DAX pushed lower. We drove, or the market was driven higher over the last days, especially, and towards the yearly highs, and DAX was driven higher by the expectation of such a discussion, respectively, potential cut then already yesterday. It didn't happen, but it's not just that it didn't happen, but there was no such discussion, which then resulted in the market giving back all these gains, respectively, in the euro, that it pushed again aggressively higher against the 111 mark here on the upside. As you nevertheless can also see is Euro didn't take on any momentum. Respectively, the DAX didn't really go aggressively lower, and for this crucial support here around 12,150 points. And in my opinion, this is something which is clearly giving a sign of what to expect in the weeks to come, not only next week, but also in the potential weeks and months to come till September. So I think what we now have is a situation in which market participants gave a clear statement of what they expect. They expect the ECB to deliver, to cut rates in September. Still, there is at least some skepticism if this can really happen then, respectively, if it really will happen. I think it will. Still, the skepticism is enough to hold the DAX then here with the cap on the upside. So short term, I have trouble to see the DAX make it back above 12,430, 470 points, even though we've now seen that the market is already going for such an attack again. Still, we didn't make it above that level yet. So this is here, this pink rectangle. And on the other hand, the dovishness, this is the ECB side, and then we will focus on the Fed in a few seconds. Then the dovishness and the expectation of such a rate cut happening, it really is giving the market a floor on the downside, so, or a support zone. We shouldn't really expect the DAX to drop based on the upcoming events, economic events. If there's no really risk of driver, no real risk of mode establishing or being established in markets, then we really shouldn't expect volatility to shoot up, and in this case, then the DAX to push aggressively lower and be towards 12,000 points minimum. But I think that we now trade for the upcoming, especially days then, till the Fed, in such a floor between 12,300 points on the downside and 12,450 points around on the upside. So this 150 pip range. Even though I have to say, I think, especially before the Fed, there is such a tendency that we will see at least a drift higher. And the reason for that is that the Fed next week, the central bank from the US central bank, is expected to deliver an equity-friendly statement. And this is nevertheless a problem because everyone is already expecting it. But from a pure statistical standpoint, and that was something we have seen in the past here, the Fed and the expectation of such an equity friendliness here, it resulted in a drift higher, especially before the days of the Fed. So there was this so-called FOMC announcement drift. It's a strategy which has been proven profitable back till 1980, I think. Next week, on Tuesday, on Wednesday, somewhere on these 2 days, there will be an article on the Traders Block section on the website, admiralmarkets.com, where you can find the details around this strategy. So we won't go into any details right now. We don't really have the time. We could easily fill 2 hours with this strategy. Okay, probably 1 hour. It's not such a spectacular strategy, but it's enough to hold a webinar here. Probably perfect for a webinar topic, by the way. With a series we start in 2 weeks from now. Oh no, I'm sorry. 1 week from 1 week from now. So we start on the 5th of August, which is next Monday, 1 week later. Yes, so the 5th of August. And this brings me to something. Let me just close this tab here, and then let's switch over to the Traders Block section, admiralmarkets.com. And then you go to analytics and there to the Traders Block. And within this, let me just probably go back here. Within this, it's the second article. As you can see here, how one trader lost 20% of his account. And the picture, this is no coincidence, it was me. So the interview we've done here is it is somehow my story. So where do I come from? How did I get started in the markets? Where did it all start? I'd really appreciate it if you read through this. So that was also one of the reasons why I didn't go into further details here on my person at the beginning, because I don't think it makes really sense, because this interview here is giving all the interesting stuff away already here. And why did we do this interview? Well, we did this because on okay, so this is interesting. Thanks for the info. That's a very good info. Let me please just go back here. We have to switch. We have to switch every time I'm switching the screen. So I'm not even sure whether you have seen the tweets a few seconds ago, because I was using this browser here. So so now I think you can see the traders block, right? Okay, perfect. Okay, I'm sorry. So this is I didn't know that. So usually it switches, and I'm showing the screen or each time the screen I show switches automatically. But here it seems as if I have to make this available manually each time. So atmarmarkets.com, analytics, traders block, and then you come here to this section, and there you have the how one trader lost 20% of his account, and this is me. So this is in fact my story. And now some of you probably wonder, why do we have this interview? And the reason is simple. If you scroll down a little, you can already see it here, and I open it in a new tab now. There's also, by the way, a banner at the end, but let's just switch over here to the Trading Spotlight series starting on the 5th of August. So what we will do here is we will go through certain areas of trading, and it's not only me here, but I'm running this with two other guys, Paul and Marcus. Both were interviewed also, and they will appear here in this interview series and Traders Block section. You can register for this series, the Trading Spotlight series, already here. We are only entering your email. And so this is what you will know at the end of the webinar. And in regards to this, I already mentioned it, as you have seen, we are very flexible in regards to topics. So, which means nothing more than we can easily, for example, give a strategy like this FOMC drift, for example, as a topic. So why do I mention it? Well, there's in the first month over August, there's also DAX strategy, there's an S&P strategy, and the S&P can already can also be traded around this FOMC drift, for example. There's also some trading psychology stuff, which I will go through with you in regards to, especially in regards to behavioral finance, for example. And yeah, so that said, this will replace this weekly market outlook webinar, and you can already register for that here. And if you want to get an idea on my person, then I highly recommend reading here this webinar. This interview, not the webinar, and then probably you'll say, okay, this sounds cool. I'll register for the webinar. By the way, if you can't join the webinar due to timing issues here, or time issues, you can also, as usual, then find the recording on the web here in the YouTube channel from Admiral Markets. And yeah, so that's it on the Trading Spotlight, on the interview. I'll close these two tabs now too, and let's probably dig a little deeper into the FOMC. I already mentioned it at the beginning of the or a few minutes ago. I mentioned the fact that I doubt that the Fed can really deliver something which is potentially driving US dollar lower, respectively, really dovish, or could be interpreted as really dovish. And why do I say that? Please remember what happened last week. We made this a topic here in the weekly market outlook, which was published on Monday. And you can see this, or you can find this also here in the Traders Block section. I would just scroll down here, and there was this let's call it uber dovish interpreted rhetoric from the NY Fed President Williams, which was shortly after revised. That we already made this a topic on Friday, last Friday, in our last weekly market outlook. He said in the speech here that to take swift action when faced with adverse economic conditions and keep interest rates lower for longer, which there are these comments were interpreted as uber dovish, even though shortly after here, and that is something you can see in this paragraph, these comments were put into perspective, and it was said that they were only academic and based on research. The problem is that the market is currently very, very sensitive in regards to such a wording, and so it didn't come as a big surprise to see probability of a 50 basis point rate cut from the Fed on July 31st then to push up to nearly 70%. As you can see now, we are down to 20% again. So there is still some market participants expecting such a step, even though the likelihood of only a 25 basis point rate cut next Wednesday is very, very high, in my opinion. And not only in my opinion, but also in opinion of the market. So nearly 80% of market participants expect exactly that. And now the thing is, if the market is already expecting such a step here by 80%, okay, then well, what can the Fed deliver in addition to that? And there, a data set, or several data sets, but one which is already published today in around 45 minutes comes into play. Obviously, when the market is already expecting such a rate cut, this is no big deal. Everyone expecting it, so no one is really surprised to see the rate cut happening then. So I think what makes more sense then is to have a look here of what does the market expect for the upcoming months till the end of the year. And the Fed Watch tool here, it delivers the opportunity to go as far as the 11th of December 2019 and have an idea of what target rates do market participants see in the future. And what you can see is the current rate is 225 to 250. We expect a rate cut already of 25 basis points next week on Wednesday. So then the rate level is 200 to 225. So then you can see that here, obviously, the market is by 50% expecting, and therefore you add up 2.2, 16, and 37.7. So with a majority of market participants, we expect the Fed to cut 2 further times. This is what the majority of market participants really expect right now, which means nothing more than right now, only 3 rate cuts are expected. But there's still nearly 18%, 18 to 20%. This is some, bouncing around a little here in this area. This is what the market is expecting in regards to 4 rate cuts. So if now the data, economic data, especially today's GDP data from the US, and this is, by the way, not very unlikely, to be honest. And I mentioned this in a technical analysis, which was published in the morning. The likelihood of a better than expected data set today at 1:30 p.m. London is very high after retail sales data around 2 weeks ago came out better than expected. And retail sales is, if I'm not mistaken, it's around 30% of the overall GDP reading. So if retail sales, as they did, come out better than expected, then chances are high that the GDP print will surprise on the upside. But if the GDP print surprises on the upside, the likelihood of a very dovish Fed statement next week on Wednesday, delivering speculation or fuel, which is pushing expectations higher here for 4 instead of only 3 rate cuts in 2019 till December, is dropping or potentially dropping, which means nothing more than the market currently prices in too many rate cuts from the Fed, which means currently the market is probably a little too skeptical when it comes to the US dollar, which means nothing more than the US dollar has some serious upside potential. And so what I want to say is that right now, more and more signs, in my opinion, point towards a very neutral, so compared to what the market is expecting, it's more neutral than dovish, in fact. So they will be dovish, they will cut rates, yes, but then everything after is already priced in, and probably it's priced in too much based on the current economic outlook. And that said, chances are very, very high that, especially here when looking at the Euro USD, that we get we have a serious chance. Oh, by the way, I'm sorry. No, let me just see. So now we have to go back to the MetaTrader. We have a serious chance that Euro USD will go for another attack of 111 and very likely push below that level. And in addition to that, we also have to say that probably when looking here at the S&P 500 on the daily chart, we pushed above 3,000 points and we stabilized at this level, and the volatility is subdued, but the market is probably expecting too much here. And chances are good that after the Fed delivered the rate cut then on Wednesday, but nothing further, that then we get to see an attack at the region around 2,960 points in the S&P. So that means we are good for a 2, 3, 4% drop probably in the S&P. I don't really think that this will act as a big market mover, but what we should be aware of is that if the S&P drops, then also the DAX has some potential for the second half of the week to see another push towards 12,300 points especially. And if we go below that level, further losses are very likely, which will then activate 12,150 to 12,200 points. So at the first week, or first half of the week, a drift higher, probably another push towards 12,500 points is an option. But the second half of the week, so Thursday, Friday, the DAX has some serious potential for another stint down towards 12,300 points if the S&P, US equity markets start to take on bearish momentum. And this is now getting really interesting. We want to focus now also here on the dollar JPY, in my opinion. Dollar JPY has here a region around 109 on the upside, which didn't play a huge role, in fact, last week at our weekly market outlook. And some of you probably recall my lines. Let me just here go back to the. So now, click. So. We want to go back to the last weekly market outlook. We scroll lower here. And as you can see here, we were quite skeptical after especially the rhetoric used by the NY Fed President Williams on Thursday, so last week on Thursday, since that is pointing to a very, very dovish approach. But now coming back to what I just said in regards to pricing out a fourth rate cut in 2019 in the second half till December, if this is really priced out, and after the dollar JPY has already seen some momentum back above 108, chances are very good that the region around 109 will be attacked. Oh, by the way, I'm sorry, 1 second. There we go. So this region around 109 will be attacked here, and if we make it above that level, further gains up to 110 are a serious option. I think we will see subdued volatility in the first half till the Fed, but if the Fed then delivers and does not deliver more than currently expected from the market, which is very unlikely, especially if data sets surprise on the upside, especially today's GDP data from the US, then I think chances are very good that dollar JPY can make it back above 109 and go for a stint up to 110. And when talking about dollar JPY and a very yield sensitive currency pair, we also have to have a look here at gold. Here, our outlook from last week played out really well. Really well and very nicely. Some of you probably recall that after the comments from Williams were put in perspective, I said, well, right now, and after this short stint above the yearly highs around 1,440 USD per ounce, I doubt that there will be follow through, but instead a drift lower, and then we'll somehow trade between 1,400 and 1,450. And this is exactly what happened here. And we drifted really lower. We traded as low as 1,410. So far, we're not taking further momentum on the downside. But this could then happen next week. especially if the US dollar can take on momentum, if EURUSD pushes below 111, and if the fourth rate cut till December is priced out. That could then mean that we're going for another stint down towards 1,380 and probably even lower than that, and try to here retest the region around 1,340, probably slightly higher than that, probably somewhere here in the middle. Some of you recall that 1,360, 1,365, that was the region which was this multi-year resistance line on the upside, which was then significantly broken on the 19th, 20th of July after the Fed delivered here the outlook of a more dovish stance in the months to come. And so a push below 1,380 is something to have in mind. So some short-term bearishness, but we will closely watch the price action in the region around 1,360 to 1,365 USD. In my opinion, there's a good chance, a very high chance, in fact, that here gold could find serious support and probably then go for another push higher, and bulls are aggressively buying this level. So we will carefully watch this region, and you will or you should definitely carefully watch this region if we get to see a significant push lower in gold here too. Any short-term bearish momentum in gold could be short-lived here, and then see some serious aggressive buying against 1,360, 365 due to the importance of this multi-rate resistance line. And as you may know, classic technical analysis says former resistance becomes now future support, and the other way around. So former support becomes future resistance. And in this case, it was a strong resistance zone, and any push above that and pullback towards that level should be carefully watched, since sometimes it means attractive buying opportunities resulting out of that from a risk-reward perspective. And that's it from my end. So I hope you enjoyed this webinar. Again, please excuse any technical issues. And then I really look forward to the Trading Spotlight series starting from the 5th of August. My first slot will be on the 7th, so Wednesday on the 7th of August, and then from the week after, so the 12th of August, my next slot will be then on the 16th of August. So I will be available, respectively, have my slots every Friday as usual. And that's it from my end. So I just hope you enjoyed this webinar. Please feel free to write an email to Admiral Markets and the support. If you have any further questions, they will forward them towards me. And feel free to read my short interview on the Traders Blog section from the Admiral Markets website to get a further idea of who am I. And I hope you enjoy it. And so that's it from my end. Have a nice weekend. Take care. Talk to you then on the 7th of August with the Trading Spotlight series, and here a first view on the trading psychology, by the way. So we'll look into trading psychology here from a general perspective, and then go dig into further details on cognitive biases a little later then in this series. And that's it from my end. So all the best, and take care. See you on the 7th of August. I look forward to it. Have a nice weekend. Enjoy yourself. See you, and bye-bye.